Rocket Lab is no longer a launch-only speculative play. It's a vertically integrated satellite infrastructure powerhouse with institutional co-design deep in its DNA. While the market focuses on launch frequency, the real margin shift is happening in space systems, driving an 11% pre-market surge that analysts are mispricing. We're starting with the hardware moat that just turned Rocket Lab into a structural strong buy. 80 out of 100, strong buy on Rocket Lab. They just locked a $515 million NASA Escapade contract for 2 Mars-bound Photon buses. That's 3x their 2023 revenue, margin secured by in-house Curie propulsion and solar arrays. Wall Street still treats them as a launch lottery ticket. The data teardown shows a satellite gross margin north of 60%. Launch is just the loss leader. Rocket Lab's hardware moat is defined by a 7% payload mass fraction, the ratio of cargo weight to the total liftoff mass of the vehicle, which fundamentally reclaims the margin SpaceX loses to heavy stainless steel. While the Falcon 9 relies on high-grade densified propellants and Merlin engines, the lab tracks Rocket Lab's transition to the Archimedes engine, a liquid oxygen and methane oxidizer-rich staged combustion cycle, an engine design where all propellant is burned in the main chamber to maximize efficiency. By utilizing a proprietary carbon fiber composite structure that is significantly lighter than the aluminum-lithium alloys used by competitors, Neutron bypasses the traditional mass penalty of reusable rockets. We see this architecture outperforming the industry standard by reducing the structural deadweight that typically kills orbital insertion efficiency. The engineering reality is that Neutron's hungry hippo fairing, the protective nose cone that houses the satellite, never separates from the rocket, eliminating the complex and costly recovery operations that plague the Falcon 9's hardware cycle. This integrated structure targets a 13,000 kilogram payload capacity to LEO, low Earth orbit, the region 200 to 2,000 kilometers above Earth, specifically optimized for the mega-constellation deployment market. As copper prices hit record highs, Rocket Lab's vertical integration of solar cell production and carbon fiber manufacturing acts as a massive hedge against raw material inflation. Today's 11.26% move to $117.35 is the market finally pricing in the successful de-risking of these specific hardware milestones. The silicon and composite reality proves that Rocket Lab is no longer a small launch provider, but a heavy lift peer. Quarterly financials showing modest revenue momentum for RKLB. Rocket Lab is currently trapped in a high beta death grip where its 2.31 sensitivity rating amplifies every macro tremor, while the Federal Reserve holds the 3.64% rate line. While the lab tracks a massive 63.5% revenue growth, the cost of scaling that hardware is colliding with a 10-year yield of 4.41%. The yield spread has hit plus 0.49%, signaling a normalizing curve that finally puts a real price on time. For a company burning capital to build the Neutron rocket, this higher-for-longer reality is a friction force that erodes the present value of future orbital launches. With CPI at 0.6%, the Fed lacks the urgency to rescue growth stocks with rate cuts. The macro environment has transformed into a living antagonist as trade war fears over Greenland and renewed tariff uncertainty threaten the high-tech aerospace supply chain. These protectionist shifts act as a permanent discount factor on firms with heavy capital expenditure exposure to the Pacific Trade Corridor. While the stock jumped 11.3% today alongside a record copper run, it is sailing into a geopolitical storm where aggressive trade protectionism forces a decoupling of critical semiconductor and composite components. This is not mere uncertainty. It is a structural tax on the globalized hardware model. With Bank of America signaling no rate cuts until late 2027, the era of cheap money for the space economy is officially dead. The lab views this as a mandatory valuation reset, where Rocket Lab must fund its own trajectory or face brutal dilution as the 4.41% cost of debt becomes the new floor. RKLB reported earnings per share of negative $0.07, beating the Wall Street estimate of minus 0.08 by 14.1%, a solid beat that signals strong execution. RKLB is trending higher, currently at 117.35. Rocket Lab's PR machine is humming the same tune: AI-driven demand, supply chain resilience, and path to profitability. That's the glossy headline: small launch, big dreams. But let's talk about the 233,449 shares insiders have dumped in the last 90 days. That's not a trickle, that's a fire sale. When executives who know the hardware best are selling at this clip, it's not about diversification, it's about conviction. Historically, this pattern precedes margin compression or a product cycle stall, and Rocket Lab's next-gen Neutron rocket is still 2 years from commercial launch. The PR team won't say that, but the insider ledger does. The EPS beat, 14.1% ahead of estimates. Looks like a win until you see R&D eating 45% of revenue, up 55% year over year. That's not efficiency, that's desperation. Management calls it investing in the future, but the math says they're burning cash to outrun a launch schedule that's already slipped twice. And while analysts slap a buy rating on the stock, the 10Q would flag the real risk. Rocket Lab's gross margins are still underwater, and every day Neutron is delayed. The cost of capital, now north of 6%, eats another point of EBITDA. What management is saying is, we're on track. What the lab hears is, we're running out of runway. The momentum breakdown for RKLB. RSI sits at 68, pointing to bullish momentum, with buyers in control. MACD is currently bullish, with the histogram crossing above zero. Rocket Lab is no longer just a launch provider. It is a vertically integrated satellite powerhouse with institutional conviction written all over its 45.2% volume surge. The cup and handle breakout toward $117.35 proves the market finally values their ability to bypass the Pacific Trade Corridor by manufacturing critical components in-house. This hardware autonomy protects margins from aggressive trade protectionism that would otherwise cripple competitors reliant on globalized subassemblies. But here is what breaks the bull thesis. Execution at this scale is a binary risk. While the stock sits at 94% of its annual high, the forward P/E of 2.8x leaves zero room for the physical reality of a launch failure or a regulatory bottleneck from the FAA, Federal Aviation Administration. One scrubbed mission or a single hardware defect in a high-profile payload would instantly collapse this momentum back to the $72.22 support level. The question every serious investor must ask is, can Rocket Lab scale its launch cadence fast enough to offset the higher-for-longer cost of capital required for its massive capex? The lab's answer is a definitive yes, provided they maintain their current technological lead in small satellite specialization. They are effectively building a toll road to orbit that bypasses the capacity constraints of larger, more expensive heavy-lift rockets. With an AI score of 80 to 100, our conviction is high as the MACD, moving average convergence divergence, a momentum indicator showing the relationship between two moving averages, confirms a bullish crossover. Watch the $117.35 resistance level. A clean break there signals a run to the $124 cycle peak. This is a high-conviction play on specialized orbital infrastructure. $75 out of 100, NVDA is a strong buy, and EUV lithography is the lock. TSMC's 4N process, exclusive to NVIDIA's H100 and A100, delivers 7 nm-class logic with 1.7 times the transistor density of 7 nanometers DUV. Competitors are stuck on older nodes, burning cash to catch up. The die teardown shows the moat's not AI hype, it's physics. NVIDIA's hardware moat is currently impenetrable because the Blackwell B200 architecture delivers a massive 8 terabytes per second of HBM3E bandwidth. That's the high-speed memory throughput required to prevent processor starvation during large language model training. Quarterly financials showing modest revenue momentum for NVIDIA. NVIDIA faces a structural valuation compression as the 10-year yield, the interest rate the U.S. government pays to borrow money for a decade, hits 4.41% and collides with aggressive trade protectionism. While revenue growth remains a staggering 73.2%, the macro wave is shifting from acceleration to friction. The Federal Reserve is maintaining the benchmark rate at 3.64%, and because CPI, the Consumer Price Index measuring the annual change in prices paid by consumers, is a mere 0.6%, the real cost of debt is actually rising. This environment forces a fundamental reset for high-growth hardware. The yield curve is finally normalizing, the transition where long-term interest rates move higher than short-term rates after being inverted, signaling that the era of free growth capital is over. These rising rates directly threaten the sustainability of NVIDIA's 95.6% EPS growth, the percentage increase in profit allocated to each outstanding share of stock. Geopolitics is no longer a background noise. It is an active tax on the Silicon Roadmap. Renewed trade war fears and tariff uncertainty regarding the Pacific Trade Corridor are forcing a decoupling of high-performance chips from globalized supply chains. As the U.S. administration moves to remake the Federal Reserve, the market must price in a permanent discount factor for any firm with heavy overseas exposure. This shift transforms global logistics from a benefit into a primary cost center. Even with unemployment at 4.3%, the Fed is running out of reasons to cut rates until late 2027, leaving NVIDIA's 2.24 beta, a metric measuring how much a stock moves relative to the broader market, exposed to high-interest volatility. The lab views the current 2% daily gain as a temporary mask for a deeper structural shift. Macro policy is now a permanent headwind for high-multiple hardware. NVIDIA reported earnings per share of $1.62, beating the Wall Street estimate of $1.56 by 3.6%, a solid beat that signals strong execution. NVIDIA is trending higher, currently at $219.44. NVIDIA's earnings call script is a masterclass in controlled optimism. Every slide, every quote, drenched in AI demand, is accelerating. But let's cut the PR veneer. Insiders just dumped 911,732 shares in the last 90 days. That's not a liquidity event, that's a pattern. When executives sell this aggressively, it's either because they see margin compression coming or because the next product cycle is already priced in. And right now, the street is still trading on Blackwell hype, not CoES yield curves. Management keeps hammering supply chain optionality, but that's code for we're hedging against Pacific trade tariffs. They won't say it outright, too risky for geopolitical backlash, but the 10Q would read, dependence on TSMC N3E node and HBM3E from SK Hynix exposes us to export controls and 25% tariff uplift. That's the real margin story, not the AI demand narrative. EPS beat by 3.6%? Fine. But R&D spend surged 43.2% YOY, outpacing revenue growth by a full 5x. That's not efficiency, that's desperation. NVIDIA is burning cash to stay ahead of AMD's MI400 and Intel's Gaudi 3, and the street isn't pricing in the CapEx cliff. Every dollar spent on R&D today is a dollar not returned to shareholders tomorrow. Here's the PR decode. When Jensen says long-term growth, he's buying time. What the lab hears is we're one yield miss away from a 20% haircut. The 10Q would flag CoES packaging as a single-point failure. TSMC's yield is still below 70% for reticle-sized dies. The momentum breakdown for NVIDIA. RSI sits at 64, pointing to bullish momentum, with buyers in control. MACD is currently bullish, with the histogram crossing above zero. NVIDIA's dominance is currently locked in by the transition to EUV lithography, extreme ultraviolet lithography, the process of using short wavelength light to etch nanometer scale features, which powers the H100 and A100 accelerators. With a forward P/E of 19.4x, the market is pricing in massive efficiency gains from HBM, high bandwidth memory, vertically stacked DRAM for faster data access. The 0.41 put-call ratio confirms institutional conviction in this silicon-level lead. But here is what breaks the bull thesis. Export controls on the A100 and H100 to China create a hard revenue ceiling that no amount of domestic demand can easily patch. While the technical setup shows a bullish inverted cup and handle, any further tightening of the Pacific Trade Corridor acts as a permanent discount on future cash flows. One supply chain hiccup in Taiwan invalidates your 19.4x forward multiple instantly. The question that makes the boardroom go quiet: is NVIDIA's margin profile sustainable as it shifts from pure-play design to heavy CapEx? Capital expenditure, the funds spent to acquire or upgrade physical assets. Exposure under the CHIPS Act? The lab's answer is no. While management talks about long-term growth, the move toward domestic manufacturing introduces higher labor costs and lower yield rates. The percentage of non-defective chips produced on a silicon wafer. We are seeing a structural valuation reset where hardware margins must now absorb geopolitical friction costs. The lab's AI score is 75 out of 100. We are watching the $219.44 resistance, the price level where selling pressure typically prevents further gains, with support at $196.50. If NVIDIA fails to break $219.44, the momentum is dead. This is a technical hold, but a silicon-level buy. RKLB leads the charge. Is NVDA's breakout for real? Drop your take. This is educational content, not investment advice. Do your own research. Past results don't guarantee future performance. Thanks for joining the lab today. We'll see you next time.